Hello, my dear students. A very warm welcome to all of you in Shri Jain the Rank Zone. I am your friend and mentor for the subject Principles and Practices of Accounting. In this lecture, we'll begin with chapter number 4, that is Inventories. All the concepts will be covered in the coming series of lecture. This is lecture number 1, and we'll begin with Valuation of Inventories, chapter 4. Let us see the learning objectives of this chapter, what we are going to learn. After studying this chapter, you will be able to understand the meaning of term inventory. Learn the techniques of specific identification method, FIFO method, first in, first out, average priced method, weighted average method, and adjusted selling price methods of inventory valuation. We'll try to understand the methods of inventory record keeping and comprehend the intricacies relating to inventory taking. Let us see a quick overview of the chapter. We have types of inventory in case of manufacturing concern and in case of trading concerns. In case of manufacturing concerns and in case of trading concerns. In manufacturing concerns, we have raw material, work in progress, finished goods, store and spares, and inventory of packing material. So these 5 types of inventories are present in case of manufacturing concerns. In case of trading concerns, we have traded goods, that is finished goods. That is finished goods. I believe you understood. Let us move ahead. If we talk about the meaning of inventory, we can say that, just try and understand what is meant by inventories. Inventories are assets that are held for sale in the ordinary course of business, held for sale in ordinary business, in ordinary business. Example, finished goods. Next, in the process of production, in the process of production for such sale. Example, work in progress, WIP. In the form of material or supplies to be consumed, supplied to be consumed in the production process, in the production process, or in the rendering services, rendering of services. Example, raw materials, raw materials. I believe you understood till here. Let us see the formula for determining the cost of inventory. So inventory valuation techniques, we have historical cost method and non-historical cost method. Historical cost method is divided into two subheads. Inventory not ordinarily interchangeable. We have specific identification method. Inventory ordinarily interchangeable. We have historical cost method, which is divided into first in, first out, last in, first out, weighted average price, and non-historical cost method, adjusted selling price. I believe you understood till here. Basis of valuation of inventory. How we will value the inventory? We need to calculate the cost. We will calculate the net realizable value NRV, and we will value the inventory on the basis of cost or NRV, whichever is lower or whichever is less. The principle of consistency is not follow over here. Why? Because for valuation of inventory, in some year we take cost, in some year we may take NRV, because whichever is lower should be taken, or the inventory should be valued on the lower value. So the principle of consistency do not apply over here. I believe you understood. Just write a note over here. Machinery spares, machinery spares which are specific, which are specific to a particular item, to a particular item of fixed assets, of fixed assets should be capitalized, should be capitalized in accordance with, in accordance with accounting standard 10 AS 10, and should not be treated, should not be treated as inventories, as inventories for the purpose of AS2, for the purpose of AS2, that is valuation of inventory, that is valuation of inventories, valuation of inventories. I believe you understood till here. Let us move ahead now. Let us try and understand the meaning of assets over here. So inventory can be defined as assets held for sale in the ordinary course of business, or is the process of production for sale, that is WIP, for consumption of production of goods or services for sale, including maintenance of supplies and consumables, other than the machinery spares. Other than the machinery spares. How come? Because the machinery spares is capitalized to the machinery equipment and standby equipment. Over here we are talking about the raw material. We are talking about raw material over here. For sale we are talking about finished goods. We are talking about finished goods. I believe you understood. There can be different types of inventory based on the nature of business of an enterprise. The inventories of trading concern consist primarily of products purchased for resale in their existing form. It may also have an inventory of supplies such as wrapping paper, cartons, and stationery. The inventories of manufacturing concern consisting several types of inventories, raw materials which will become a part of goods to be produced, work in progress, partially completed products in the factory, and finished goods. So basically we can say that the inventories are of three types: inventory of raw material, inventory of work in progress, inventory of finished goods. In manufacturing concerns, inventory will also include maintenance supplies, consumables, loose tools, and spare parts. However, inventories do not include spare parts, service equipment, and standby equipment, which can be used only in connection with the item of fixed assets and whose use is expected to be irregular in nature. Such machinery spares are generally accounted as a fixed assets and will be capitalized in the fixed assets. Similarly, we can say that in an enterprise engaged in construction business, project under constructions are also considered as inventory. At the year end, every business entity needs to ascertain the closing balance of inventory. The closing balance of inventory, which comprise of inventory of raw material, closing balance inventory of WIP, and inventory of finished goods and other consumable items. Value of closing inventory is put at the credit side of the trading account and asset side of the balance sheet. So, before preparation the final account, the accountant should know the value of closing inventory of the business entity. However, we shall restrict our discussion on inventory valuation of a manufacturing concerns and goods of trading concern. Let us continue. So, we'll learn what is included in the cost of inventories. What is included in the cost of inventories? In the cost of inventories, we can say that as per AS2 valuation of inventories, cost of inventories include number 1, cost of purchase. Cost of purchase. But cost of purchase include purchase price, duties and taxes. But those duties and taxes which are recoverable should not be included over here. Other expenditure directly attributable to acquisition like freight inward but excludes the trade discount, rebates, duty drawback subsidies on taxes which are subsequently recoverable. So those taxes or expenses which are recoverable in nature should not be a part of cost of purchase. When we purchased the product, then we should include cost of conversion. Cost of conversion. Basically, this includes direct labor, direct expenses, subcontracted work, and production overhead absorbed on the basis of normal capacity of the business. Some other cost also that is to be included. Other cost incurred in bringing the inventories to the present location and condition. Example, we can say that cost incurred in designing the products for specific customer, that is also a part of inventory cost. Next is what is excluded from the inventories. What is excluded from the inventories? Number 1, abnormal amounts of material wasted. Abnormal amounts of material wasted, labor or other production cost or other production cost. Number 2, storage cost. Storage cost unless those costs are necessary in the production process, prior to a further production stage. Prior to a further production stage. Third, admin overhead, administrative overheads, that do not contribute that do not contribute to the inventories bringing the inventories to their present location present location and condition. Fourth, selling and distribution cost. Selling and distribution cost. So these should be excluded from the inventories. I believe you understood. I believe you understood this. So basically, if we talk about inventory, we have inventory of stock and we have inventory of spares. In case of spares, if this spares can be used with only a particular machine, in that case this is not an inventory, this should be included, this should be capitalized as a part of that machine, that is a non-current assets. But if this spare could be used with any machine, in that case that this would be used as a value as a inventory. Let's talk about inventory of stock. In case of manufacturer, and we have in case of trader. If I talk about in case of trader, we have only inventory of finished goods. If I talk about manufacturer, we have inventory of raw materials, we have inventory of work in progress, and we have inventory of finished goods. I believe it is pretty clear till here. Let us continue. So, if you think of a manufacturer to value the cost of inventory, how a manufacturer will be calculating the cost of inventory? So, cost equal to cost of purchase, cost equal to cost of purchase plus cost of conversion plus cost of conversion, cost of purchase plus cost of conversion. If in case of trader, if in case of trader, in case of trader, how the cost is calculated? So we have, while calculating cost, we have cost of purchase of finished goods, cost of purchase of finished goods. I believe you must have understood. Let's talk about goods now. Let's talk about goods. Whenever there is a manufacturing of goods, whenever there is a manufacturing of goods, we need to pay excise duty. So excise duty is on production. But excise duty is a recoverable duty. Excise duty is a recoverable duty. So those duty which are recoverable in nature should not form part of valuation of inventory. So excise duty is recoverable duty. Let's talk about value added tax, that is VAT. VAT is also recoverable. VAT is recoverable in nature. CST, Central Sales Tax, this is not recoverable in nature. Not recoverable in nature. We also have custom duty. If we are importing some raw material, the custom duty needs to be paid on that. But that custom duty, the nature of custom duty is non-recoverable duty. Custom duty is a non-recoverable duty. So those duties which are recoverable in nature should not be included in valuation of inventories or calculation of cost of inventories, because it is going to be recoverable. But those basically which are not recoverable should be added while calculating the cost of inventories. Let us see an example over here. Let us see an example over here. Example. There is a bill. We are making a bill. 100 units are sold at rupee 10. So the total is 1000 rupees plus value added tax at the rate of 4%. So 40. The total is 1040. 100 units are sold at the rate of 10 rupees. VAT is charged at the rate of 4%. The bill is 1040. Over here, from this, 60 units are sold. 60 units sold. 40 units are still there in closing stock. 60 units are sold and 40 units are still there in closing stock. So how we will value this closing stock? How we will value this closing stock? Just see it well. So 60 unit is sold, that means 40 units are there in closing stock. So 40 units multiplied by 10 rupee, that is 400. VAT will not be included while calculating closing stock. Why? Because VAT is a recoverable tax, so it should not be added while calculating the value of closing stock. Just write over here, VAT, value added tax, is a recoverable tax, so so not be added to the value of what? Value of closing stock. Have you understood? Let us continue. Let's see one more example. Let us see one more example. We are making a bill. We are making a bill over here. So 100 units at the rate of rupee 20. That amounts to 2000. CST is charged, Central Sales Tax, at the rate 2%. So 2% of 2000. 2% of 2000 is 40. So total is 2040. Out of this 100 units, 70 units sold. 70 units sold. That means what? 30 units are there in the closing stock. 30 units are there in the closing stock. We are supposed to value the closing stock. What is the value of closing stock? This needs to be calculated. Give it a try. Give it a try. How we'll do it? My dear students, you should understand over here one thing, that central sales tax, this means CST, CST over here is not recoverable in nature. We cannot recover CST. We have learnt over here CST is not recoverable. So those taxes which are not recoverable should form as a part of valuation of closing stock. So over here, the value of 100 units, the value of 100 units is 2040. So the value of 30 units, that is the closing stock, is, just calculate, is 30 multiplied by 2040 divided by 100. Try to solve it. 30 multiplied by 2040 divided by 100. This is 612. This is the value of closing stock. Value of closing stock. I believe you understood. This is the value of closing stock. I believe you understood. Let's see this. Example 2. Let's see. Let's talk about discount. So discount is of two types. We have cash discount and we have trade discount. Cash discount and trade discount. You should understand over here that cash discount will be treated as indirect incomes. Cash discount is a kind of indirect income. So cash discount is basically is offered for making the prompt payment, and that is why it is a indirect income. Where it is shown in profit and loss account. So cash discount is shown over here by discount received in profit and loss account, by discount received on the credit side of profit and loss account. I hope you understood. Okay, so let's see this example over here. So supposingly the cost is 100. The cost is 100. The 10 is tax that is added over here. So total it is 100 and tax. But out of this tax 10, 6 rupees is duty drawback. 6 rupees is duty drawback. What is duty drawback? We had paid a tax or duty of 10 rupees, and out of those 10 rupees, 6 is recoverable. So 6 is duty drawback. So what would be the cost? The cost is 104. How come? 100 is the cost, 10 is the tax on that. The billed amount is 100, tax is 110, so total is 110. Out of that, the duty drawback is 6. This we are going to receive it back. So total is 104. So this is the billed amount. The cost to be recorded. I believe you understood. Let us see how cost can be calculated. First of all, we have purchase cost. We have purchase cost. Then freight to be added over here. Freight inward. Taxes to be added over here. Taxes. Which kind of taxes? CST and customs. Then if we are giving any kind of discount like trade discount would be deducted. Trade discount will be deducted. Any rebate received will be deducted. and duty drawback. I believe you understood the meaning of duty drawback. And so this is how we can value the cost, or cost can be calculated. I believe you understood till here. Okay, so you learned about cost. Let us learn about net realizable value, that is NRV. Let us learn about NRV. So while calculating NRV, we have estimated selling price of the product. From this estimated selling price of the product, the estimated cost could be deducted. Estimated cost to make sales, this needs to be deducted, and whatever we received, this is nothing but net realizable value, that is NRV. That is nothing but NRV. Let us move ahead and learn how to value inventory. Inventory valuation. A primary value in accounting A primary value in accounting for inventories is to determination of value at which the inventories are carried in the financial statements until the related revenue is recognized. Inventory is generally the most significant component of the current assets, which it is held by the trading or manufacturing enterprise. It is widely recognized that inventory is one of the major assets that affects efficiency of operations. Both excess of inventory and its shortage affect the production activity obviously, and the production of enterprise, whether it is a manufacturing or trading business. Proper valuation of inventory has a very significant bearing on the authenticity of the financial statements. The significance of inventory valuation arise due to the various reasons as explained in the following points. The importance of inventory valuation arise due to the various reasons as explained in the following points. Let us see point number 1, that talks about income determination of income. The valuation of inventory is necessary for determining the true income earned by the business entity during a particular period. To determine gross profit, cost of goods sold is matched with the revenue of accounting period. Cost of goods sold is calculated as follows. Cost of goods sold equal to opening inventory plus purchases plus direct expenses and minus closing inventory. So inventory valuation will have a major impact on the income determination if merchandise cost is larger fraction of sales price. The effect of any over or understatement of inventory is explained as follows. Just see it over here. When closing inventory is overstated by mistake, net income of the accounting period will be overstated. When opening inventory is overstated, net income of the accounting period will be understated. When closing inventory is understated, then the income of the accounting period will be understated. And when the opening inventory is understated, the net income of the accounting period will be overstated. Just try to understand this fact well. Try to understand it well. When closing inventory is overstated, the net income of the accounting period will be overstated. When opening inventory is overstated, the net income of the accounting period will be understated. When closing inventory is understated, the net income of the accounting period will be understated. And opening inventory is understated, the net income of the accounting period will be overstated. The effect of misstatement of inventory figure on the net income is always through cost of goods sold. Thus, proper calculation of cost of goods sold, and for that matter, proper valuation of inventory is necessary for the determination of correct income. The second point is ascertainment of financial position. So inventories are classified as current assets. The value of inventory on the date of balance sheet is required to be determined. That is closing inventory. The financial position of the business in statement of financial position. In case the inventory is not properly valued, the balance sheet will not disclose the truthful financial position of the business, and that is why proper ascertainment of closing inventory at the balance sheet date is a must. Third is liquidity analysis. So inventory is classified as current assets. It is one of the components of net working capital, which reveals the liquidity position of the business. Current ratio, which studies the relationship between current assets and current liabilities, is significantly affected by the value of inventory. Current ratio, the formula is current assets upon current liabilities. And over here, this current asset includes what? Includes the value of inventory. Fourth, statutory compliance. Schedule 3 of the Companies Act 2013 requires valuation of each class of goods, that is raw material, WIP, finished goods under the broad head to be disclosed in the financial statement. As per the requirements of accounting standard, the financial statement should disclose A. The accounting policies adopted in measuring inventories, including the cost formula used for the valuation of inventory. Next, the total carrying amount of inventory and its classification appropriate to the enterprise. Carrying amount of inventories to be disclosed. The common classification of inventories are raw material, that is inventory for raw material, inventories of work in progress, and inventory of finished goods. Stock in trade in respect of goods acquired for trading, and spares and loose tools. Inventory of spares and inventory of loose tools. I believe it is crystal clear till here. Let us continue and see another topic, that is the basis of inventory valuation. How we will value the inventory. Inventory should be generally valued at a lower of cost or NRV, that is net realizable value. Cost or NRV, whichever is lower, as per the accounting standard 2 valuation of inventories. This principle is governed by the principles of conservative accounting or prudent accounting, under which any expense or losses from transaction entered or event occurred are to be recognized immediately, but any gains or profits that are recognized until it's become due or are actually realized under the principle of lower of cost or NRV, any loss due to decrease in sales price of the inventory below its cost is recognized immediately. I repeat, under the under this principle, the lower of cost or NRV, any loss due to the decrease in the sales price of inventory below its cost is recognized immediately, as it is anticipated that the enterprise will make loss whenever it will sell this product. I believe it is clear. Let us continue and see how we will calculate cost. As per accounting standard 2, cost of inventory should comprise of all cost of purchase, cost of conversion, that is primarily for finished goods and work in progress, and other costs incurred in bringing the inventories to their present location or present condition. Cost of purchase consists of purchase price including duties and taxes other than those subsequently recoverable by the enterprise. This means what? That those duties and taxes which are recoverable by the enterprise should not form the part of closing inventory or inventory. Freight inwards and other expenditure directly attributable to the acquisition. Trade discounts, rebates, or duty drawbacks and other similar items are deducted in determining the cost of purchase. In other words, Cost include any amount paid to the seller reduced by any discount received, rebate received, given by the seller. Similarly, any duties paid by the supplier will be a part of cost of inventory, but unless the enterprise can recover these taxes duties from the authorities. This means what? That only those duties should be included in the value of cost that should not be irrecoverable. That is, that should not be recoverable. Irrecoverable duties will be a part of cost. I repeat, irrecoverable duties are included as a part of cost. Cost of conversion of inventories include cost directly related to units of production, such as direct labor. They also include a systematic allocation of fixed as well as variable overheads. Other costs may include administrative overheads incurred to bring the inventory into present location and condition, or any cost specifically incurred on inventory of a specific customer. Interest and other borrowing costs are generally not included in the cost of inventory. However, the same circumstances where production process is longer and it is required to carry inventory for a longer period of time, like wine, rice, timber, it may be appropriate to consider interest and other borrowing cost also as a part of inventory. Let us learn the exclusions from cost of inventory. So following expenses are generally not included in the cost of inventories. Let us quickly learn it. Abnormal amount of waste material, that is labor and other production overheads, storage cost, unless these costs are necessary in the production process prior to further production stage. Third is admin overheads, administrative overheads that do not contribute to bringing the inventories to their present location and condition. And fourth, selling and distribution cost. Selling and distribution cost. So we have seen about cost, we have learnt about the cost. Now let us learn how to calculate the net realizable value. How to calculate NRV, net realizable value. So this is estimated selling price in the ordinary course of business less the estimated cost of completion and estimated cost necessary to make the sale. In case of finished goods and traded goods, the net realizable value (NRV) will generally mean selling price which reduced by selling and distribution expenses. In case of work in progress expenses and overheads required to be incurred to convert the work in progress into finished goods and make it ready for sale will also be reduced for selling price. In case of raw material, replacement cost is generally considered as net realizable value. Understood? In case of raw materials, the replacement cost is generally considered as the net realizable value. An assessment is made of as each balance sheet date. Inventories are usually written down to net realizable value on an item by item basis. In some circumstances, however, it may be appropriate to group similar or related items. Example, in case of interchangeable items, it may not be possible to identify the cost or NRV and NRV of each item separately. Let us see an example. Purchased 100 units at rupee 20, freight inward rupee 100, sold 70 unit at rupee 30, estimated selling price estimated selling price rupee 24, estimated selling expenses rupee 2.5, value closing stock. So what is closing stock? 30 units. We need to calculate the value of closing stock. I believe we understood the question well. Let us try to solve it. Let us try to solve it. First, we need to calculate cost. 30 units are there in the closing stock. 30 units are there in the closing stock. What would be the value of it? How we will value it? As you can see over here, 100 unit, the value is rupee 20. And for 100 unit, the freight inward is rupee 100. That means freight inward is 1 rupee per unit. This means what? Freight inward is rupee 1 per unit. What is the value of closing stock? The closing stock is 30 units over here. 30 unit multiplied by 21. How we calculated 21? 20 plus 1. This 1 relates to freight. This 20 relates to purchase price. Understood? So 30 multiplied by 21 equals 630. Let's see cost. Cost is done. Let's see NRV. How we will calculate the NRV, net realizable value. So we have 30 units. What is the net realizable value? The estimated selling price is 24, but the estimated selling expenses is 2.5. The selling expenses is 2.5. So 24 should be deducted. 2.5 should be deducted from 24 because we'll receive 24 by selling and 2.5 we need to incur. So 30 units multiplied by 24 minus 2.5, that is 21.5. So 30 multiplied by 21.5 is 645. Now cost or NRV, whichever is lower, we need to value the inventory as per cost or net realizable value, whichever is lower. So we will write value of closing stock, value of closing inventory equals dollar 630, rupee 630, that is cost or NRV, whichever is lower. Cost or net realizable value, whichever is lower. I believe it is clear to all of you. Have you understood this example? That was quite simple. Okay, let us proceed. Let's see one more example on the same lines of action. Just note it down. Example. Example. Purchased 200 units. Purchased 200 units at the rate rupee 10. VAT is chargeable at the rate 10%. We sold 150 units. From 200 units, we sold 150 units. Let's record the estimated selling price. Estimated selling price equals rupee 15. Let's try to value the closing stock. What would be the value of closing stock? Record the question well, and then we'll proceed with the answer. Kindly record this question well, and then we'll proceed with the answer. Let us continue. First of all, we should calculate the cost. 200 units, 150 sold. So 50 is the closing stock. 50 unit multiplied by rupee 10. See, VAT is a recoverable cost. VAT is a recoverable levy, recoverable tax. So that is why for the valuation of closing stock, we will not include VAT. So 50 unit multiplied by 10 equals 500. If I talk about net realizable value, again 50 units multiplied by what is the net realizable value? Estimated selling price is 15 and there is no extra cost is there. So it would be 15 only. So 50 multiplied by 15 equals 750. What would be the value of this stock? Value of inventory equals rupee 500. What we have formula we have used? Cost or a net realizable value, whichever is lower. Is it clear to all of you? I believe it is clear. Let us move ahead. Let us see one more example. Let us see one more additional example. Purchased 100 units. Purchased 100 units at rupee 20. Excise duty, we need to pay 12%. Value added tax is 4%. Value added tax is 4%. Sale, we already sold 70 units. Calculate the value of closing stock. Calculate the value of closing stock. Over here, how we will calculate the value of closing stock? From 100 units, we had already sold 70 units. So 30 units are there in the closing inventory. That should be valued at rupee 20. That should be valued at rupee 20. Why this is valued at rupee 20 and excise duties is not included? Because excise duty is recoverable. Excise duty is a recoverable tax. Recoverable tax, hence it will not form part of closing stock and should not be included in the valuation of inventory. So 30 multiplied by 20 equals rupees 600. What is this? This is cost. This is cost. What is NRV? The NRV data is not available in the question. See it carefully. The data about the net realizable value is not given in the question. Always assume over here that the NRV is above cost. Assume net realizable value is above cost or more than cost. So if net realizable value is more than cost, cost or NRV, whichever is lower, cost is the lower. So we will value the inventories. Value of closing inventory equals closing inventory equals rupee 600. I believe it is clear. 600 is the value of closing inventory. Let us move ahead. Write one more example. Write one more example. So this example is basically based on item by item basis. Item by item basis. I am listing the items over here. We have item A, item B, item C, item D, and item E. Let's record the cost of the items. Item A is the cost is 500. Its NRV, net realizable value, is 492. Item B, the cost is 240 and the net realizable value is 270. Item C, the cost is 486 and net realizable value is 495. Item D, the cost is 315. The net realizable value is 310. Item E, the cost is 290. Net realizable value is 340. The total cost is 1831. This is the cost total, and the net realizable value, the total is 1907. The total of NRV is 1907. We need to calculate the value of inventory item by item basis. My dear students over here, if you could do like this, cost or NRV, whichever is lower, this is the lower, but we can't do so. We have to see item by item basis. Item by item basis, that means first item, the A, 500 and 492, whichever is lower, so it is 492. B, 240, 270, whichever is lower, so it is 240. C, 486, 495, whichever is lower, so it is 486. D, 315 and 310, whichever is lower, it is 310. Or E, 290, 340, 290 is lower, so it would be valued at 290. Let us do a quick totals of it. 492 plus 240 plus 486 plus 310 plus 290 equals 1818. 1818. So we can say that value of inventory, this is the value of inventory item by item basis. Understood? I believe it is pretty clear. I believe it is clear till over here. Let's see what we have learnt in today's class. So we have seen the meaning of inventories. Then we seen how to value inventories, the basis of inventory valuation, cost or NRV, whichever is lower. After that, we shifted to what is included and what is excluded as a part of inventory, how a manufacturer record inventory, how a trader record inventory, goods, excise duty, recoverable, VAT, recoverable, CST, not recoverable, custom duty, not recoverable. We had seen several examples in relation to this. How to value inventory. The basis of inventory valuation, cost or NRV, whichever is lower. What should be included in the cost and how to calculate net realizable value, that is NRV. And we have seen some serious example based on these topics. And the last example that we have seen today is example on the basis of item by item basis. I believe you understood till here. Let us stop here. We will resume in the next class now. Thank you.